Okay, welcome to Module 6 on Chapter 6, related to deductions and losses. So, the way this book is organized, deductions are going to get scattered across the next few chapters, and losses are actually scattered across a couple of chapters that are different than the deduction ones. So, to some extent, this is a little bit of an overview and then a dive on just a handful of items, knowing that we will get to more later. All right, so we're going to talk about business and investment deductions in this video. We're going to talk about what restrictions there are on our ability to take deductions. We'll talk about the timing of those deductions, and then we'll do a few special rules around deductions and losses. So let's start with our friend, Section 162. And Section 162 is just a wonderful code section. We should all learn to love it, because it says that you can take a deduction for all ordinary and necessary business expenses. And that's just wonderful, because that gives us permission to deduct business costs. Section 212 says you can deduct all the ordinary and necessary expenses associated with the production or collection of income, or for the management, conservation, or maintenance of property held for the production of income. So we normally think of 162 as being the trade or business code section, and 212 as being the production of income code section. There are other specific expenses that are deducted by the tax code, and a couple of these we've even talked about, things like educator's expense. Remember, for the K through 12 instructors, moving expenses. This is when we talked about a few of those 4 AGI deductions previously, because they weren't covered elsewhere in the book. We had to just jam them into an earlier chapter. So those are, of course, examples of other specific expenses that you can take. So a lot of these roll through Schedule 1. So you can see Schedule 1 by now. Since you've done a tax return, we've seen this schedule. We didn't have a lot of numbers appear on it, but we've talked about it before. You can see on line 12, there goes business income or loss. And down on line 17, rental real estate, royalties, partnerships, S corporations, etc., and it's attached Schedule E. So Schedule C and E are supporting schedules that drop, think of it like a net figure onto this schedule. But amazingly, note that this is an income schedule. Here's that list of 4 AGI deductions that we've already looked at before that has the educator's expense and alimony now we see on there, and a handful of other things. So we're going to start with the top of Schedule 1. And yeah, it's all about income, but we are talking about deductions today, because we're talking about, at least here initially, deductions from business, production of income, or investment activity. So Schedule C is the sole proprietorship, right? That's the one you use when you own a business as a sole proprietor, so there's no separate legal entity. And Schedule E you can think of as when you're reporting income from a separate legal entity. And that's any entity except for the most part, corporations. Because corporations can only distribute income through either wages or dividends to their owners. And so as a result, well, that's not entirely true, but but typically that's the way they're going to come through. And so they would be reported elsewhere, right? We've already seen where wages are reported, and we've already seen where dividends are reported in our previous tax return exercise. So deductions related to activities such as the ones above, the sole proprietor and the flow-throughs, they're largely reported as part of the profit and loss of that activity. So think of it as those deductions are taken before we even get to Schedule 1. And there are some exceptions. So, for example, we noted back on the second half that the self-employed health insurance deduction comes here. The deduction for self-employment tax. These are both things associated with self-employment that aren't reported down on those subsidiary schedules, but are instead reported separately as 4 AGI deductions. And so they're worthy of mention so that we don't forget about them. So here's what a Schedule C looks like. Well, not all of it, but at least the expenses part. And you can see that basically the IRS wants us to detail out in some reasonable method what are the expenses of this particular business. And they've created these categories that are common categories. It doesn't mean these are the only expenses that are deductible. It means this would be a way of capturing probably 80% of the expenses that a small business incurs. And so they just put the lines on the schedule for us to create that sort of itemization. Line 27A, you'll note, is other expenses. That comes from the backside of Schedule C, where you could list additional expenses as needed. And large companies will often have a statement that they attach to the tax return because all the other expenses simply don't fit on that detail on the back of the Schedule C. So in any event, you can see that we would detail these out, and they come to a net profit there on line 31. And just to be clear, it says, look, if it's a profit, enter it on Schedule 1, Form 1040, line 12, right? So just to go back, Schedule 1, line 12 of Form 1040 is business income or loss from the Schedule C. So you can see that this is really just a subsidiary schedule that feeds up to Schedule 1 that ultimately feeds into the 1040, and this is how you capture self-employed or sole proprietorship business income. This is what the front page of Schedule E looks like, and the front page of Schedule E is for rental and royalty activity. So this is typically associated with the personal ownership of rental properties or royalties, which is payments for intangibles. And you report these here. And again, I haven't shown you all of Schedule E, but I've captured the expenses. So you can see it's basically follows the same sort of pattern as Schedule C did, right? It's kind of like provide an itemization of the typical expenses that are associated with rental or royalty streams of income. And line 19 is kind of your catch-all if you have other types of expenses. And if you look down on line 26, it says, hey, figure out what your total is, enter it on Schedule 1, Form 1040, line 17, which is where you're capturing that information on Schedule 1 to ultimately then report up into the 1040. So again, Schedule E is simply a subsidiary schedule to Schedule 1, just like Schedule C was. So the backside of Schedule E is basically where you report your flow-through business income. So this would be income from partnerships, LLCs, and S corporations. And you can see that it functions quite a bit differently. That instead of there being a big list of expenses that you're supposed to total, instead you basically report this as either income or loss with no additional detail. And if you look down at the bottom under Part 5 Summary, you can see it says combine them all together, and guess what? Report them here and on Schedule 1, Form 1040, line 17. So again, this is another subsidiary schedule. The backside of Schedule E is the subsidiary schedule to package together all of your flow-through income. Now, you can imagine, of course, that the IRS would not for a second permit you to not provide any detail. So let's first think about how an individual would receive the reporting of this income from a flow-through entity, right? There's some separate entity, some separate business entity, again, non-corporate entity, and it's operating a business. And it needs to somehow inform the partners or the S-corp owners of what their share of income is so that they can report it here on Schedule E. That's done typically through a K-1. There's a K-1 for partnerships and a K-1 for S-corps. And you can see over in Part 3 on the other side that we capture this information in some level of detail as either line 1, ordinary business income or loss, and then what we call separately stated items, which are all the other items on a K-1 that capture some form of income or a deduction that needs to be reported through to a partner or owner's personal tax return. So obviously this is still done in summary form as well. So suffice to say, on a partnership tax return itself, which a partnership tax return is a Form 1065, it's a Form 1120S for an S corporation. This is where you see that same old itemization of expenses that we've grown used to, right? So a partnership would complete a Form 1065. They would then allocate that income or loss to each of the partners using a K1. That partner would then report it on their Schedule E. That Schedule E would flow up to Schedule 1, and Schedule 1 ultimately totals down onto the Form 1040. Okay, so you can see it's really just a series of supplemental schedules that feed up to the actual owner, who is a tax-paying entity and ultimately reports it. Recalling that really individuals and corporations, again, trusts and estates can be, but individuals and corporations are the tax-paying entities, and everything else is simply a flow-through. Okay, so now that we've seen how that reporting system functions, let's talk about these business deductions. And effectively, the same rules apply under 162 as 212 with respect to these general concepts. So we can apply the rules interchangeably between the two. So deductions must be directly connected to a business activity. They must be ordinary and necessary and conducive to profit generation. And they must be reasonable in amount. And reasonable amount means not extravagant. So things that are not deductible would be an item that requires capitalization, which again we talked about in a previous module. We'll talk about it some more in this one. And then some other ones are expenses related to tax-exempt income, expenses contrary to public policy, expenses for political contributions, and then there's a limit on interest expenses. And we'll talk about each of those in detail later in this video. So first we need to ask ourselves, are we in business or not? And as a general rule, corporations are almost universally treated as if they are in a trade or business. Now, a corporation can misbehave and be like an investment corporation that only holds passive investments and can find itself in trouble. But generally speaking, a corporation is treated as a business, kind of as a default. Otherwise, as an individual, you'd ask, is this activity engaged in for profit? If it's engaged in for profit and not a hobby, then you can consider yourself either to be in business or for the production of income. So I've used these terms a little bit, but we really need to figure out what might be different about them. So let's think about what trade or business is versus production of income, and to some extent versus investment, but investment is a little easier to differentiate. And we should know that there's really no single definition. There's no set definition that you can follow that says, oh, based on this bright line test, it's a trade or business or it's production of income. And in fact, the lines are quite blurred between these categories. And generally speaking, the classification of trade or business versus production of income depends in large part on the amount of time spent on the activity. And we're not going to unpack it a whole lot more than that, but there are some court cases with respect to this issue. So Donald owns a large number of commercial properties, for example, hotels, golf courses, office buildings, etc. And he spends most of his time working on these activities and derives the bulk of his income from them. Well, this certainly sounds like a trade or business enterprise, and it would be treated as one. In fact, it almost sounds like it could be more than one trade or business enterprise. Jared, on the other hand, is an employee in Donald's business. So most of the time he spends at work as an employee, and most of his income comes from his services that are being earned as an employee. But Jared also owns a condo on the Jersey Shore, and he rents that out during the summer. And he just pays a management company to handle rentals, cleaning, and etc. Well, this is more like production of income, right? So it's hard for Jared to claim that his trade or business is the rental of that condo at the Jersey Shore. His trade or business is actually being an employee. Don Jr. is also an employee in Donald's business, but he spends most of his time, or at least some of his time, managing his trust fund portfolio. And he doesn't do that as a living, meaning he doesn't manage anyone else's investments. He really only self-manages his own. Well, that's neither for the production of income nor trade or business. That is simply for investment purposes. So why does it matter? Well, it matters because there are different limitations and different availability of deductions depending on which category your activity falls into. So, for example, Section 179, which is a depreciation recovery code section allows the deduction of up to $1 million of property cost as long as that property is used in a trade or business, meaning production of income does not qualify. So as a result, you can see that in this situation, it could really matter. It's the choice between capitalizing and depreciating under production of income, or perhaps being able to deduct the cost up to $1 million under 179 if it's a trade or business. Another example would be Section 199A, our old friend, the QBI deduction. So that's 20% deduction of flow-through income. It only applies if the activity is a trade or business. It does not apply to the production of income. And so as a result, we're not going to get that 20% deduction if we do not qualify as a trade or business. So again, this classification truly does matter. So since we're talking about the QBI, let's do a little dive on the definition here of a trade or business. And it might help a little bit with our general understanding of what's going on. So code section, the regs to code section 199A, because that's what that is. That's a regulation, right? The one dot tells you that. Defines trade or business as a trade or business under code section 162, other than the trade or business of performing services as an employee. So what this means is 162 has the guiding principle on what it means to be a trade or business, which is wonderful. It's fine. The code can cross-reference to itself elsewhere. The problem is there is no guidance under 162 on what it means to be a trade or business. It simply says trade or business expenses are deductible if they're ordinary and necessary. So let's go back to our example of Jared, right? Jared was an employee in Donald's business. And most of the time, and most of his income was earned as an employee of Donald's business. But again, he also owns how many condos, right? Some number of condos on the Jersey Shore that he rents out during the summer. And the reason I left it blank as opposed to saying one is that how many condos would it take before Jared runs a trade or business, right? So if it's just one, we could probably argue, yeah, that doesn't really feel like a trade or business. But if suddenly Jared is managing or owning and operating, 12 properties on the Jersey Shore, that might be a little bit different, right? This may no longer simply be some form of production of income, but rather it meets the standard of a trade or business. So we didn't get, when they passed the new tax cut law, they didn't give us a lot of guidance on what it means to be a trade or business under 162. In fact, they really gave us nothing new. But they've come along here in 2019 and issued some guidance for us to follow through the form of a proposed regulation that came out in Notice 2019-7. And that simply means that was the 7th IRS notice in the calendar year 2019. And in this, they provide a real estate safe harbor. So a rental real estate enterprise will be treated as a trade or business if the following requirements are satisfied, right? So here's the safe harbor. You maintain separate books and records to reflect income and expenses for each rental real estate enterprise. Okay, so you got to keep books and records. Number 2, you spend, at least for taxable years prior to 2023, 250 or more hours of rental services being performed each year with respect to those enterprises. So what that really means is, look, you need to spend 250 hours a year if you want to qualify as a trade or business under the safe harbor. And then Part C says you have to maintain contemporaneous records, including time reports, logs, or similar documents that are contemporaneously documenting the amount of time you served in that capacity. So basically, it's like, look, this is the rule that says you can't just wait until year end and be like, yeah, I spent about, 2 hours a day doing something, and so that's going to be enough, right? So the idea is you're supposed to retain a log, and this is not inconsistent with a lot of the ways that the IRS requires supporting documentation. It's generally thought to be created contemporaneously with the day or week or whatever it might be in which the activity took place. Okay, so let's think about this 250 hours for a second, right? So over 12 months, that's about 21 hours per month, or about 5 hours a week. So in order for this rental safe harbor, so let's think about this for a second, it only applies to rental type businesses. and I think of real property, but I don't know that for sure. And it only applies if you're choosing the safe harbor. If you want to try to establish that your activity is a trade or business through some other means, by all means have at it. All right, so lastly, while we're on the QBI again, the QBI is equal to the net profit of whatever that flow through is, right? So qualified business income. But you actually get to modify that a little bit. And I say that from the perspective of, remember when we talked about just a few slides ago, we said, look, you take Schedule C and you report that number, but there were a couple items, right? Self-employment health care, self-employment taxes that were reported separately. Well, those are actually considered deductions for the QBI. So you might come down to a bottom line number on Schedule C, line 31 of X, but then you can go deduct from X items like self-employment taxes and self-employment health insurance, and any contributions to qualified retirement plans, less any savings on the self-employment taxes. So again, these items aren't reported on those supplementary Schedule C and E, but instead were reported through the AGI for AGI deductions on Schedule 1. Okay, so let's presume for a second we have the meaning of what a trade or business is down, and I would argue we don't really, but probably good enough, at least for this class, because we could probably battle over this legally for a good long while. We need to talk about ordinary, right? Ordinary and necessary. So ordinary means reasonable in amount. It means reasonable and proximate. It has a reasonable and proximate relationship to an income-producing activity, and that it's customary or usual in that type of activity, meaning that it must not be personal in nature. So as you can imagine, think of it as there being a continuum, right? And at one end of the continuum would be an expense that really is purely a business expense. So, for example, if you were paying wages to one of your employees, you'd probably say, look, that's just a business expense, right? I just have to pay that person. There's no personal attribution associated with it. But think back to our Dr. Susan Collins, my sister, the dentist, who was paying her daughter, right? Is there some taint? Does that taint that expense in some way? I just like saying taint because it has some personal aspect to it. Take uniforms. That's a great example, right? So if you're a firefighter, you have a distinct uniform that you wear. It usually has, a label on it, and patches, and it says who you are, and it's built for firefighting. Whereas if you're an office worker, you just kind of wear the same sorts of clothes that everyone wears. Well, the office worker probably can't deduct the cost of their quote-unquote uniform because those clothes are personal in nature. All right. So let's say we have Georgia, and Georgia is self-employed, right? So let's say she has a small Schedule C business, and she flies first class to all of her conferences and business meetings. So would that be reasonable? And actually, even though it feels like maybe it wouldn't be, right, because she's flying first class, the service has a pretty strong history of being pretty liberal with respect to what it means to be reasonable. Necessary, appropriate and helpful in the taxpayer's business. So reasonable is also part of that. But wait, that was part of ordinary, so we've kind of already covered reasonable. And typically reasonable only arises in related party settings. So let's say that Rick owns a business and employs his brother Ben. Ben's paid $45,000 per year by Rick's business. In comparison, other employees that do the same thing as Ben, but happen to not be Rick's brother, are only paid $30,000 a year. And so what the IRS would say is, hey, that payment to Ben, that $45,000, that's not a reasonable amount of compensation. There's something else going on there, like maybe a gift or something of that nature. Okay, so again, there's a liberal interpretation of what ordinary and necessary means by the service. And so as a result, you do not see them routinely question strict business expenses. It tends to come more from when they're slipping into the personal arena. But there are exceptions. We're going to talk about each of these exceptions here in a bit. So related parties, for example, like a business owner and his brother, like the example we just did, majority corporate shareholder in a corporation or a partner in a partnership. These are all forms of related parties where the amount paid to by a business owner to his brother, that's a related party. And so it could be that the IRS is going to scrutinize that a little bit more seriously than they would otherwise. Okay, so let's say we have our friend Ripley, and she owns 100% of an S corporation, which is a flow-through, that's involved in an active trader business. And when Ripley provides services to that corporation, right, she's an employee as well as an owner, the entity is required to pay her wages, right? A reasonable wage must be paid. So let's look at how that could affect the outcome of Ripley's S corporation and the activity associated with it. So let's start in the column where the S corporation is going to pay Ripley wages. So we're assuming that the S corp generates income of about $100,000. The wages that it's paying to Ripley are $60,000. So as a result, that S corp has net income after the wages of $40,000. So what happens is both the wages and the S corp income flow through to Ripley. So she pays employment taxes on the wages. So it's her and her S corp both split it, but since she owns all the S corp, we can legitimately kind of think about that as all being hers. So she pays employment taxes of 15.3%. And then, of course, she pays income taxes, and I just assume 24%. We don't really know what Ripley's marginal tax rate is, but we can go ahead and assume 24%. Why not? And she pays that amount as well. So her net after-tax cash flow from that $100,000 of activity is $66,820. So it looks to me like her tax bite is 33.2%-ish, right? So if, on the other hand, Ripley decides she's not going to pay herself any wages, right, and that may or may not be realistic depending on the service that Ripley is providing to her S corp. But let's assume for a second it's zero, at least hypothetically. Now all the income simply flows through, and so what happens is no employment taxes are assessed against that allocation of income. So instead of having employment taxes and income taxes when there's no wages paid, of course, there's only income taxes. And as a result, Ripley's net after-tax take is higher. It's $76,000 instead of $66,800. So in this example, Ripley is clearly better off paying herself no wages, and that's because she saves on employment taxes. Well, look, the IRS knows this. And so the tax rules require a deduction for a reasonable wage, or in other terms, a fair market value wage. But as you can imagine, that could be really difficult to measure. So it's often open to interpretation. All right, so when we finished the last section, we talked about how freewheeling we can be with our business deductions. But as you can imagine, there are limitations, and we need to deal with what those limitations are. So one of them, under 162M, which is getting a lot of press, or was getting a lot of press, it'll die down quite a bit now. 162M is a limit on compensation paid to the CEO, CFO, and other three highest paid officers in a public corporation. And basically, 162M limits the deduction for compensation to $1 million for any of those five highest paid individuals. And again, it's a public corporation, so you need to be traded on a stock exchange, this sort of thing. So let's say Big Corp, a public corporation, pays its CEO $1.4 million. What is the after-tax cost of the compensation? So let's start with where there is 162M. So the pre-tax outflow is $1.4 million, right, because they pay the CEO $1.4 million. Then we need to determine what is the tax savings you can generate. Well, since you can only deduct $1 million, the tax savings you can derive from that is only 21%, or $210,000, which means the after-tax cost is the $1.4 million less $210,000, or $1.19 million. If, on the other hand, there was no such limitation on this deduction, then the 1.4 million pre-tax outflow remains the same. However, now the deductible amount would be the full 1.4 million and would generate tax savings of 294, lowering the after-tax cost, right? So what's happened is 162M simply increases the after-tax cost of compensation over $1 million. So I don't want to spend a ton of time on this because this really has an effect on the corporation, not on the individual, and this is an individual tax course. So we're kind of done with 162M. Okay, another limitation on deduction is, of course, something that you capitalize, right? And we've already discussed this in a previous module where we know capitalization means we put it on the balance sheet first, and when we capitalize it versus when do we deduct it. And so this becomes a big issue, right? Because we know that ordinary and necessary business expenses are deductible, but they are not deductible if we're required to capitalize them. So the basic rules are if that expenditure improves or creates a betterment that increases the value of something, then you're required to capitalize it. Or if it restores the property to its original operating condition, then you're required to capitalize it. And those are just the basic rules. There's a fairly new set, in 2014, maybe 2015, of new rules called the property regs, and they're pretty much beyond the scope of this course. In my mind, I'd like to think you covered them in 332, but there's probably a pretty good chance you didn't there either. But if you go into the graduate tax program and you take my 657, I cover them there. So, a few important notes on property regs. There is a de minimis safe harbor. So businesses with what's called applicable financial statements can deduct expenditures up to $5,000 as long as that's the book policy as well. So large corporation, take GE for example, they probably have a book policy that says, look, if it's less than $5,000, we're not capitalizing that cost as an asset. We're just deducting it. We're just expensing it for book purposes. And as long as they have that, they can do the same for tax purposes. If you do not have applicable financial statements, which think of them as audited financials, then you can still have a de minimis safe harbor. It's up to $2,500, so $2,500 can still be written off. So this is a pretty favorable rule for determining whether you have to capitalize a cost or not. There are also a couple of repair safe harbors that are generally applicable. So let's start with some rules for real property. So the first one is called the safe harbor for small taxpayers, and this relates to when the property has a cost of $1 million or less, and you can treat each building that you own separately. You don't have to combine it all together, so if your aggregate cost is more than $1 million, that's not relevant. The expenses that you're trying to deduct cannot exceed 2% of the building's unadjusted basis. So unadjusted basis is its cost, up to $10,000 per year. And you have to be a business that generates annual gross receipts of less than $10 million. So Sam owns a single family home that he rents out. It cost $100,000, so clearly not in San Diego, right? During 2018, he paid $200 to a plumber to fix a leak. He repaired a window for $400 and replaced the home's hot water heater for $1,200. So the leak you could probably categorize as a repair on its own. The window, we even describe it as a repair. But the home hot water heater, normally you'd think of as, well, you have to capitalize that cost, right? That's a furniture or fixture that has a useful life beyond the end of the tax year. However, Sam can qualify for the small taxpayer safe harbor because the $1,800 he spent during the year is less than 2% of the unadjusted basis, right? And so he can just go ahead and deduct all $1,800. So again, probably $600 of that would have been deductible without the safe harbor, but this certainly sweeps in the other $1,200 as well. So there's also a safe harbor for something called routine maintenance, or the SHRM. So the shrooms, right? So you can take a shroom if you're not required to capitalize as an improvement and therefore deduct amounts that meet the following criteria. So they need to be paid for recurring activities that you would expect to perform as a result of your use of the property in your trade or business, to keep that property in its ordinarily efficient operating condition, and you would reasonably expect to do that for buildings or building systems more than once in a 10-year period beginning when it was placed in service, or if it's not a building, more than once during the class life of the unit of property. Okay, so there's a lot of tax language built up in here, so let's do a couple examples. So let's say you use a car in your business. So you're buying a car for your business, a brand new car. Car has a class life of 5 years. Would you expect to change the oil more than once during the 5 years? And the answer is almost certainly yes, right? I mean, you typically have to change your car oil every 3,000 miles or, blah, 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 blah. And so you could probably think, yeah, there's a pretty good chance I'm going to change the oil in that thing more than twice. And as a result, you can just apply the routine maintenance safe harbor and for sure deduct it. And again, you'd probably treat that as a repair anyway. A new transmission, on the other hand, you would probably not expect to change that out during the 5-year period. You'd like to think the transmission's going to make it for the full 5 years. Now, that's not to say you couldn't classify it as a repair. You might be able to, but you're not going to be able to apply the safe harbor to that because you would not ordinarily expect to replace that transmission more than once during the class life. Okay, so let's look at something about a building, right? Let's take a carpet, for example. So if you had an office building, would you expect to replace the carpet more than once in the 10-year period? Recall that for buildings, it's a 10-year period. And carpet, probably not, right? Not in 10 years, although 10 years is getting pretty long in the tooth for a carpet. Probably depends on the type of office building. But let's go with probably not. But on the other hand, if it was carpet for your daycare center, right? So you've got kids throwing up on your carpet all the time. Pretty good chance that you would need to replace that within the 10-year period. And so as a result, you could probably apply the safe harbor to an improvement like that. All right. So capitalization is only one non-deductible type of expense. Some of the others we've already talked about these, so let's dig in. Expenses related to tax-exempt income, contrary to public policy, or other specific ones. So let's talk about tax-exempt income, and let's talk about this really through the classic example. So Offworn Corp borrows $100,000, and it uses that $100,000 to turn around and purchase $100,000 of tax-exempt bonds. So Offworn is a corporation, so it's going to take a deduction for the 4% interest it pays on the loan, right? Because it borrowed the money, so it pays interest of $4,000 every year. The after-tax cost of that, since Offworn's a corporation, is 3.16%. However, it generates a 4% both pre-tax and after-tax return on those tax-exempt bonds. So this creates an arbitrage opportunity. Obviously, the more Offworn would borrow and buy, the greater income they would generate. So there's just no way to lose here unless the bonds went under on you. So as a result, the tax law does not permit the deduction of expenses related to the production of tax-exempt income. So as a result, that interest expense would not be deductible by Offworn Corporation. Contrary to public policy, is an old piece of code, but over the years has been narrowed substantially, and it was narrowed by the court system, frankly, because the IRS got a smidge abusive about it, right? So deciding what was contrary to public policy started to become within the purview of the actual revenue agent dealing with your case, and that is not a place that we really want to be in the United States. So instead, the Congress went back and sharpened the pencils a little bit and said, look, the things we're talking about are illegal bribes and kickbacks that are paid to a government, and fines and penalties. And that's really it. That's where that stops, right? So contrary to public policy doesn't extend a lot beyond those two categories. It was expanded with the Tax Cuts and Jobs Act in late 2017. So for 2018 and forward, that also includes a deduction for settlements, legal settlements related to sexual harassment cases, when a non-disclosure agreement is part of the deal. So if a corporation or a business is settling a sexual harassment case and they require a non-disclosure agreement as part of the settlement, then they may not deduct the cost of that case. So this is tax policy weighing in on maybe some pretty good social policy as well. Probably depends on your perspective. Expenses associated with an illegal activity are generally deductible. So the IRS really has incentive for you to report your illegal income. And so as a result, it allows you to also deduct your expenses associated with the generation of that illegal income. And it does that in all instances except for when it's associated with the trafficking of controlled substances. So basically, drugs. So for example, transportation costs for the trafficking of human sex workers, that's entirely deductible. However, the transportation costs for trafficking weed, that is not deductible. And you should recall that the rules on gross income permit a cost of goods sold deduction. So the cost of goods sold for drug dealers is deductible, but none of their other expenses, at least for federal income tax purposes, are deductible because those are expenses associated with a federally illegal activity. Okay. Political contributions and lobby costs are not deductible. This has been a long-standing rule forever and ever. In the old days, you could actually deduct payments made that were designed to affect only local legislation. That was removed as well. So pretty much political contributions and lobby costs remain non-deductible pretty much across the board. Business interest limit. This doesn't apply if your gross receipts are $25 million or less. So this would only be an individual who is operating a pretty significant size sole proprietorship. It's not really geared towards that sort of entity anyway, as you can imagine with a gross receipts test of 25 million. We're really aimed at larger businesses here, but the rule is that interest can't exceed interest income plus 30% of taxable income. So it just places a limit on the amount of interest you can deduct. And I don't think we're going to spend any more time on that topic. It just doesn't fit well inside of an individual course. All right, our friend Manny is a single taxpayer. He works for a lawn maintenance company. But Manny's had it with working for the man, and he wants to go into business for himself. And he's going to specialize in converting lawns into low water usage gardens. And he thinks he'll have some liability issues, right? Because he'll have employees working outside and there'll be contractors. And so the risk of injury is somewhat high. So he knows he's going to incorporate, right? So it's going to be, Manny's Landscape Incorporated, whatever it might be. But even before that, he wants to prepare a market study because he wants to look at which neighborhoods in San Diego have the big lawns and probably use the most water and would probably be the best target for his services. And so he wants to do a market study. So he also contacts an attorney to set up his corporation. He's not going to do LegalZoom.com. He's going to pay someone. And he hires a graphic designer to prepare some marketing materials because, he wants a logo and he wants the right pamphlets and materials or whatever it might be. Maybe he's just going to put a card in a bag of rocks and throw it on driveways. But whatever it is, he wants it to look nice. And so he's engaged the services of a designer to help him with that stuff. So Manny incurs all these costs, let's say in January of 28. So he's corporate organization costs, he pays the lawyer to set up his corp. The market study's $3,500 to go out and get some data, and his graphic designer costs him $1,700 more. But Manny opens for business in April, right? So he gets all that stuff done, and bang, on April he quits his job and opens for business, right? And starts booking clients. The problem is when we look at Manny's costs, we'd like to say they're trade or business costs. The problem is Manny wasn't in a trade or business then because he didn't open for business until 18. And so technically he would need to capitalize those costs, which is a bummer for Manny because, look, he's just getting started in his business and the risk of failure is the highest now. And now he's incurred all these costs that he generates no tax savings with. So typically we would say these are not deductible. Under 162, they are in fact not deductible because he is not yet a trade or business. So the tax code provides a loophole for this, thankfully, under Code Section 195, and it classifies them as either startup or organizational costs. And these are two different things, but they largely get treated in exactly the same way. So let's start with org costs. Org costs are expenditures to form a corporation or partnership. Things like organizational meetings, state fees, accounting service costs, incident to organization, and legal services. This is not the cost of selling, marketing, shares or ownership, right? So a large public corporation, when you do an IPO, you actually have to go out to the investment community and have people do what's called syndication, which is they agree to purchase a certain number of shares. And you usually have an investment banker who helps you with that, and you pay the investment banker a lot of money to help you do that. That is the cost of selling and marketing shares or ownership. Startup costs are the cost to start up a business, right? So the cost of investigating a trade or business, pre-operating costs, and again, you can't deduct these because you're technically not in business. However, cost recovery for both works the same. The general rule is you amortize these over 180 months, which is 15 years, starting the month in which you start business activity. So when you truly become a trade or business. However, there's an exception. There's a small business deduction, and it works a lot like Code Section 179, but we haven't even covered that yet, but maybe you have elsewhere, which allows you to deduct up to $5,000 of your startup costs or up to $5,000 of your organizational costs. Remember, we would treat them separately, just in the same way. However, you have to be a small business, and a small business is considered one that has startup and organizational costs that are less than $50,000. To the extent you exceed $50,000, there is a dollar for dollar phase out of your ability to deduct those costs, not your ability to amortize, but simply deduct those costs immediately. All right, so let's first do Manny's example. Recall Manny had corporate organizational costs of $4,500. Manny would say, hey, that's way less than $50,000, so I'm a small business. I can deduct up to $5,000, so I'm going to expense, therefore deduct the entire $4,500 in 2018. When we look at his startup costs, recall there were two of them, right? Combined, they were $5,200. Again, that's less than $50,000, so he's clearly a small business. He can deduct up to $5,000. However, the remaining $200 has to be amortized over 180 months, starting in April, because that's when he started business. So you take the $200 divided by 180, multiply by 9 months, or $10. So he would deduct in total $5,010 in 2018 for his startup costs. So you can see you do not need to combine organizational costs and startup costs. They each stand alone. It's just they're treated the same. Okay, let's roll through a bunch of similar examples. V Corp incurs organizational costs of $4,000. They start business on April 13. How treated for tax? Well, they only incurred $4,000. That's less than $50,000. They can deduct all $5,000, all $4,000, right? Because that is less than the limit. What if instead their org costs were $7,000? Well, this is similar to the startup cost that we just had with Manny. So they can go ahead and deduct the $5,000, but the remaining $2,000 is going to have to be amortized over 180 months. And again, since they also started in April, that's 9 months worth. What if the org costs are $51,000? Okay, so now V Corp is starting to feel less like a small corporation because the org costs exceed that $50,000 threshold. So as a result, we need to phase it out. So first we'd measure what is the amount over the threshold. Well, $51,000 minus $50,000 is $1,000 excess. As a result, we're required to reduce the amount he could immediately deduct by that $1,000. So the $5,000 is now reduced to $4,000, which means that V Corp can expense $4,000, and the remaining $47,000 will be amortized over 180 months, etc., etc., etc. Okay, what if V Corp's org costs were $56,000? Okay, well now what's happened is all $5,000 is phased out. We're $6,000 in excess of the threshold. Therefore, there's no amount that can be immediately deducted, and all $56,000 is amortized over 180 months. All right, and again, if you change org costs to startup costs, it works exactly the same. All right, let's talk a little bit about the timing of deductions, right? So when does a taxpayer get to deduct an expenditure? So the timing of deductions is covered under Code Section 461, and it says that the deduction allowed shall be taken for the taxable year, which is the proper taxable year under the method of accounting for calculating taxable income. And I would argue that statement is totally useless, right? It just says the deduction will be allowed in the proper year. Well, thanks, but you didn't tell me what the proper year is. So as we know now from the income section, we have two types of taxpayers with respect to timing. We have cash basis and accrual basis. So we're going to start with cash basis. And the rule is you recognize deductions when they're paid. And there is no such thing as constructively paid, right? Because recall, for income, we had this notion of constructive receipt, which broadened what it meant to recognize income. Well, there's no such broadening under the cash method for deductions. And in fact, there's a court case, a tax court case, that says there is no such doctrine as constructive payment. And then, in fact, deductions are a matter of legislative grace. So, yeah, it just means you deduct them when paid. All right, so let's see if that applies to all situations. So, December 31st, 2017, Wendy pays her business insurance premium for 1/1 to 12/31/2018, and it costs her $12,000. So here we are in 2017, and she prepays her insurance premium. So that's not uncommon, right? You usually have to pay your insurance before the policy period begins. You don't always have to pay all of it, but you usually have to pay at least part of it. So the book accounting for this would be debit prepaid and credit cash, right? And then you would amortize that cost over the life of the policy. That would be a pretty common accounting treatment because it provides good matching, right? I'm expensing it over the period in which is actually the benefit period, the policy period of 2018. So there'd be no expense in 2017, and instead the expense would be amortized through in 2018. So does tax do the same thing, right? So tax would say, guess what? That expenditure provides a future benefit beyond the end of this taxable year. As a result, you're required to capitalize it. And so tax would match books the same. But there's an exception. This exception is called the 12-month rule. And the 12-month rule applies to both cash and accrual-based taxpayers. And it says you may deduct that cost immediately if the benefit is expected to last equal to or less than 12 months, and the benefits do not extend beyond the end of the following tax year. And the 12-month rule simply does not apply to interest expense. So if you prepay interest expense, you cannot apply the 12-month rule. So let's see the 12-month rule in action for a second, knowing that the two rules are less than or equal to 12 months and not beyond the end of the following tax year. All right. So December 1st, 2017, this corporation, which is cash basis, pays a $10,000 property insurance premium for a 12-month term that starts 12/15/2017. Okay, so that start date is important. So does it extend beyond the earlier of? Number one, 12 months, right? So does the policy last more than 12 months? Well, no. As a matter of fact, this one lasts exactly 12 months. So perfect, that fits. So far, we're immediately deducting it. Second, does the end of the taxable year, does the benefit period extend beyond the end of the taxable year following the taxable year in which the payment is made? Okay, so when is the payment made? 2017. When does the benefit period extend to? Well, it's a 12-month term starting 12/15/17, so it ends 12/15/2018. That is before the end of the taxable year after the payment was made. As a result, they can actually go ahead and deduct this entire payment on the date it's made on December 1st. All right, let's change that example in only a slight way. So again, here we are in December of 2017, and we're going to pay it. But the insurance benefit period, the policy period, starts February 15th of 2018. So first, do we meet the first rule, right? Again, same thing. It's a 12-month policy, so we meet the first one. However, now the benefit period does extend beyond the end of 12/31/2018. As a result, it goes beyond the end of the next tax year, and as a result, the 12-month rule cannot apply. Instead, you capitalize and amortize the entire cost, right? So that means you can't deduct. Well, you can't say, well, wait, almost all of it is next year. Can I deduct that part? No. You must capitalize all of it and amortize all of it because it does not meet the 12-month rule. All right, so that's cash basis taxpayers. How about accrual based taxpayers? They follow, oh, there's some familiar language, the all events test. But now there's an additional requirement called economic performance. So a taxpayer deducts an expenditure when all the events have occurred that establish the fact of the liability. It can be determined with reasonable accuracy, which is a little bit like the mirror of the income side. Recall that it was fix the right to receive and reasonable accuracy. And then the additional requirement of and economic performance has occurred. Okay, so to deduct something as an accrual-based taxpayer, you have to meet the all events test and economic performance. Okay, so a liability is any item allowable as a deduction, cost, or expense for federal income tax purposes. Got it. What is economic performance? Well, economic performance depends on what the underlying transaction is. So the obvious one is when you buy services or property. So I'm buying services from someone or I'm buying goods from someone. Well, when economic performance occurs is probably exactly when you thought it occurred to begin with. So it would occur when the services or property are provided. So for example, if I'm buying, widgets, then economic performance occurs when the widgets are provided to me. If I'm buying legal services, then the legal services economic performance occurs with respect to those legal services when they are provided to me. When property is used by a taxpayer, then it occurs when the property is used. So we think about the use of property as being something like rent or lease. And so that tends to occur ratably over time because that is typically how you use that property. If services and property are provided by a taxpayer, then economic performance occurs as such services or property are provided. And then there's this last category called payment liabilities. And I'm going to break payment liabilities down into two types, even though they're all payment liabilities. So payment liabilities are rebates, refunds, awards, prizes, insurance, and warranties. These are defined in the code, in the regs, as payment liabilities. Economic performance with respect to those types of transactions only occurs when the payment is made, which means there's no real accrual of those types of costs. Payment liabilities B, and again, I've made up these terms. There's no such thing as payment liabilities A and payment liabilities B. I break them down because you'll see why in a little bit. Are torts, violations of law, and workers' comp payments. Again, the same rule applies. It's economic performance occurs when payment is made. So as far as economic performance occurs, there's no difference. Thing is, there are exceptions to the economic performance rules. One of them is something called the recurring items exception. So if the all events test is met, then economic performance will have been deemed to occur if actual economic performance does occur within 8.5 months. So for example, for a calendar year end, that would be by September 15th. Such an item is recurring in nature and it's not particularly material, and the accrual results in better matching. So this recurring item exception is a way of getting rid of some nuisance differences between the way you might accrue something for your financial statements and the way you would have to do it for tax. And this tries to conform the two to make them match. The reason I described payment liabilities in two different forms is that you cannot apply the recurring item exception to payment liabilities B. You can never apply it to interest. Interest is only deductible over time period. All right, our next section, so we've been through a series of disallowed expenses. Now let's go through a series of disallowed losses. So, because like deductions, certain losses can be disallowed as well. And we've already covered some of these. For example, the loss on sale or exchange of personal use property. We covered that back in Module 5. So if you sell your car at a loss, you can't deduct that loss. Now, there is a narrow exception for casualty losses. We'll do that when we get to chapters in 7 and 8. It is even more narrow than it used to be. We also covered net capital losses in excess of capital gains, right? A net capital loss is when your capital losses exceed your capital gains. But we know there's a $3,000 exception for individuals. They can actually go ahead and deduct $3,000. Now we're going to cover some new loss disallowance rules. Wash sales, related party losses, hobby losses, certain rental losses, and then we capture the home office deduction under that because it's limited in many of the same ways. So Gordon Gekko buys 100 shares of Blue Star Airlines on January 3rd, 1995 for $100 a share. Then in 28, Blue Star is now only worth that should probably be 2018. Blue Star is now only worth $20 a share, but Gordon wants to hold on to the stock until it rebounds. At 9:30 a.m. on the last day of 2008, he purchases 100 additional shares at $20 a share. 1 minute later, he sells those initial shares that he bought in 95. As a result, he realizes and, of course, wants to recognize the loss of $8,000, right? So that's the $80 per share that the stock has gone down in price. Okay, let's think about Gordon's transaction here, right? Because economically, he is no different than he was when he started. He owned 100 shares of Blue Star. He sold 100 shares, but 1 second later, or 1 minute earlier, he purchased 100 shares. So kind of what happened is nothing. In fact, there's no difference between where he started and where he finished. All right, welcome back to me. Someone stopped at my office. Then I finished recording this video. And then I realized I never pressed record again when I finished the recording of the video. So now I'm at home finishing the recording of the video. Okay, so I believe where we left off was there was economically no difference in Gordon Gekko's situation. He owned 100 shares. He still owns 100 shares. He effectively was at no risk. IRS doesn't really like this. So under Section 1091, if the taxpayer acquires substantially identical property 30 days before or after the sale of property at a loss, that loss will be disallowed. So these are called the wash sale rules, and they apply primarily to securities. So this would have been Gordon's loss, right, as he sold 100 shares for $20. His basis was 100 shares times $100, so he had a realized loss of $8,000. So if we step through the wash sale rules, we'd say, did he purchase substantially identical securities? And the answer is yes, he purchased the exact same stock. Did he do it within 30 days before or after the date of the sale at a loss? And the answer is yes. It turns out he did it on the exact same day. And were they originally sold at a loss? And the answer is yes. So as a result, we need to apply the wash sale rules, which means no loss will be recognized. Instead, that loss becomes part of the basis of the substantially identical property purchased. So recall that Gordon bought new shares. That's 100 shares, not $100, but 100 shares at $20 each. That would have been basis of $2,000, but to that he adds the $8,000 of loss that is deferred as a result of the wash sale. As a result, his adjusted basis in the new shares is $10,000 in what could only be described as nothing but a coincidence. That was the basis in his shares previously. So in a way, what the wash sale rules do is force you to carry the basis forward. It's as if you never sold them. And so as a result, what is common in the tax code is when the basis gets carried over, the holding period tacks on. So if ultimately Gordon sells these shares that he repurchased and gets out of the position, then he would get long-term treatment because he gets to tack the holding period on of the original shares to the holding period of the new shares as well. All right, another loss that is restricted from deduction is a related party loss. And these come in two flavors. Well, there's more than this, but the two that this book deals with. The first is more of a deduction, and the second one is a loss. But because this book mixes all sorts of stuff up, there's no surprise there. But it did put all the related party things together. So the first rule has to do with the deduction, and it says that an accrual-based payer may not accrue cost to a cash basis related party until it's actually paid. So if you have an accrual-based taxpayer, they may not deduct the cost associated with a payment to a cash basis related party until that is actually paid. So GG Corp accrues a bonus to its sole shareholder, Gordon, and normally it might have every right to do so, but GG Corp will not be permitted to deduct that bonus until it is paid, because the GG is a sole shareholder, therefore he is a related party, and they will not be permitted to take that deduction until they actually pay the bonus. The other form is in the form of a loss. So in this case, Donald owns 100 shares of stock in MySpace. He purchased it at $100 per share, and now it's only worth $2 a share. So Donald wants to recognize the loss, but he's not quite prepared to give up on his MySpace stock yet, thinking it might be the next Twitter. Now, he knows that the wash sale rules would trap him, so he can't do a sale and a quick buyback, or a buyback and then a quick sale. So he comes up with his own half-baked idea, which in this case is to sell the stock to his wholly owned corporation, Trump Corp. So in this case, the 200 minus the 1,000 is an $800 loss, and Donald's psyched. He gives the wahoo, only to realize that Code Section 267 disallows losses on sales between related parties. So let's walk through how we apply this rule, because not everything is bad news. And to do this, we're going to go through 3 separate scenarios. So in all these scenarios, we have the previous example of Donald selling property at a loss to a related party, Trump Corp. And now Trump Corp is going to sell it in 3 different scenarios under Scenario A, 1,200, Scenario B, 800, Scenario C, 100. So let's start with Scenario A. So here's Donald's transaction, right? His amount realized is the 200 he receives for selling it to Trump Corp. His adjusted basis was 1,000. His realized loss is 800. But on the related party sale rules, he's not allowed to deduct any of that. And so it's all deferred. Whereas Trump Corp now sells it for $1,200. Their adjusted basis is the 200 that they bought it from Donald for, which gives them a realized gain of 1,000. However, under the related party rules, they are eligible to capture up to the amount of their gain, the amount of loss that was deferred on the related party sale. So you can see what happens then is Trump Corp can capture, or you might say recapture, the $800 deferred loss that Donald had, and they end up with only a $200 recognized gain. So that's a pretty good outcome. Let's go to Scenario B. So nothing changes for Donald in Scenario B. He sells it to Trump Corp under the exact same circumstances. But now when Trump Corp goes to sell it, their amount realized is the 800 minus their adjusted basis of 2. They end up with a realized gain of 600. They can only offset their realized gain with the loss to the extent of the realized gain. So as a result, they can only use 600 of Donald's loss of 800. What happens to the other 200? It evaporates. It goes up in smoke. It's gone forever. In Scenario C, Donald is still the same as he is in all the other scenarios. And now Trump Corp only sells that stock for $100. Well, since Trump Corp's adjusted basis is 200, they have a realized loss of 100. As a result, they can deduct none of Donald's deferred loss against their gain, and that $100 loss is recognized. However, none of Donald's 800 can ever be recognized and simply evaporates. So since these related party rules can have a significant effect on whether a loss can be recognized, it's important to understand what does it mean to be a related party. So you can be a related party through family. So family members that are considered a related party are spouses, brothers and sisters, including half-brothers and half-sisters, father, mother, grandparent, or any other ancestor, like a great-grandparent, and children, grandchildren, or something like great-grandchildren, any other lineal descendant. all of these are treated as a related party under 267. In addition, an individual that owns more than 50% of the stock in a corporation is also a related party. Now, note that this says more than 50%, so exactly 50% is not a problem. However, stock ownership is subject to something known as the family attribution rules. And the family attribution rules attribute the ownership of one family member's stock to another family member. So in this case, Jane owns 30% of X Corp. And Jane's spouse Terry also owns a different 30% of X Corp. However, under the family attribution rules, all of Terry's shares would be attributed to Jane. Thus, Jane would own her 30% plus Terry's 30%, or 60%, and therefore Jane and X Corp are related parties. The exact same is true for Terry. Jane's shares would be attributed to Terry as well, and as a result, Terry would also be a related party. Okay, so one of the next areas of deduction restriction is on hobbies. Now, hobby income is always recognizable. It's hobby losses that are non-deductible. And in the old days, it used to be that you could deduct your hobby costs up to your hobby income, but the new rules are quite different. You can no longer deduct any hobby costs except for cost of goods sold. So when we're trying to figure out if something is a hobby, we're basically comparing it to a business, right? Because we know trade or business expenses are deductible and they don't suffer these limits. So how can we tell the difference between a hobby and a business, since a business can create a loss? So there's a safe harbor test, and the safe harbor says if the activities generated a profit in 3 of the last 5 years, including the current tax year, then it's a business. So you just got to generate some profits 3 out of 5 years. If you do not, the other factors you're forced to consider are things like, have you conducted it in a business-like manner? What is your expertise in the area? What's the time and effort you're putting forth? What's the expected appreciation in value? Have you had success in similar activities? Have you had a history of profits or losses? What are the amounts of those profits if you've had any? What is your dependency on your profits personally to survive? And what are the elements of personal pleasure that might be derived from the activity that are tainting your ability to treat it as a business? So one of the classic examples is, and the book does a good job of describing this, was breeding horses, right? There's a very common activity by the affluent, and as a result, suffered consistent scrutiny by the service on whether that was a hobby or a business. In my example, Gail is a physician. She's built a very profitable practice, and she also has developed a pretty good golf game. And so now she's practicing many times per week in an effort to try to go pro. So the problem is Gail has not made a single dollar in winnings yet, but she has spent a lot of money trying to get ready to go into this as a profession. So she has $20,000 on her annual country club membership. She spent $4,300 on new clubs and $500 on supplies like tees and balls and towels and whatever else golfers use. So when we look at this, we have to say, well, does this fit as a hobby or a business? And as much as Gail might be trying to make a go of it, she certainly doesn't meet the safe harbor. And unfortunately, this activity is tainted with all sorts of personal pleasure problems, right? So it's likely that she had her country club membership before she tried to become a golfer. In addition, clearly you would derive a certain amount of personal pleasure from playing golf all the time. She has no expertise in the field. We'd have to look at the kind of level of activity she's engaged in, et cetera, et cetera, et cetera. So likely, Gail would have to treat this as a hobby. As such, she'd have to include any income she's earned, which in this case is none. But she also would be ineligible to deduct any cost except cost of goods sold. Since this is a service business, there is no cost of goods sold. We typically think of cost of goods sold being associated with manufacturing, merchandising, which is retail, and mining, but not service businesses. So as a result, she'll get no deduction. Okay, in a similar thread, when you rent your dwelling, at least in part, you may see that it has different loss or income treatment. So let's start with what a dwelling unit is. Think of that as your home, and that could include an actual home, right? So like a single family detached dwelling, but it could also be a condo. It can be a mobile home. It can be a boat, a townhouse, and lots of other similar properties that you own. Now, once you own this home, you could, of course, use it solely for personal use, right? So that's my home here in San Diego. My family and I live in it, and we don't rent it to anyone else. You could have a mixture of personal and rental use. So I like to think of that as a vacation home. So you could have a vacation home in Hawaii that you live in for 1 month while you're on vacation. But of course, the other 11 months you rent it out to try to make it more affordable to own a home in Hawaii. And then lastly, it could be solely rental use. So you could own an apartment down in Pacific Beach that you rent out to SDSU students. And that's all you do, because who on earth would want to share a place with a bunch of SDSU students in PB? All right, so whether you treat that dwelling as a residence or a non-residence depends on how it is used. And what we're going to see is there's a number of different classifications that we apply to dwelling units. There are 3 of them. And you apply any of these 3 if the home is rented for any period of time at all. Otherwise, it's simply just a home, right? So I've applied my terms, and then I've also used the book's terms in parentheses beside each one. So the 3 categories are primarily personal use, or as the book says, a residence with minimum rental use. The in-between category, which the book describes as a residence with significant rental use, and primarily rental use, which the book calls a non-residence. The classifications are significant because they affect the recognition of either income or deductions, or maybe even both. So let's start by counting what it means to rent a unit and what it means to use it for personal use. So personal use days are days that you, the taxpayer, stay in the home. They also include days that your relative stays in the home, even if that relative pays fair market value. However, there is an exception. If the home is the relative's principal residence, then you can actually include that as rental days. So let me give you an example. Let's say that I own a place let's go with PB, and I rent it to my brother and his family. My brother and his family live there all year long. It is their principal residence. They're not just vacationing. In this situation, as long as I'm charging fair market value for rent, then I can include that, or I should exclude that from personal use days and count it as rental days. If, on the other hand, I have a place down in PB and I simply rent it all the time, and it's on weekly rentals for tourists, and one of the weeks I rent it to my brother, even if my brother pays fair market value, in this particular instance, I would not be able to count that as rental days. Instead, those would be considered personal days. If I am staying in a different home, under a vacation, home exchange, or a swap, those are considered personal days. And if I rent it out at less than market value, those are also considered personal days. Rental days are when I rent it out at fair market value, or they're days that I spend maintaining or repairing the home to get it ready for its rental use. When the home is available for rent, but it's not rented out, so this is days it's on the market, so to speak, these are neither personal days nor rental days. Okay, so before we dig in on how we deal with the income and deductions associated with a dwelling for which there's at least some rental use, I need you guys to better understand the way a couple of itemized deduction works. The first itemized deduction is one you get for mortgage interest paid on debts secured by your principal, not principal, so bad spelling there, principal residence, are deductible as an itemized deduction. So individual taxpayers can deduct the mortgage interest on their principal homes. These are from AGI deduction, so an itemized deduction. And as well, they can deduct real property taxes on their principal residence. Now, of course, they're subject to a $10,000 cap. We'll deal with all this when we get to Chapter 7. in more detail, but we need to understand that both of these items are deductible anyway as an itemized deduction, whether they're personal or business. And we'll see why that's important when we do allocations. And by the way, since we're talking about it, a second home can also qualify as your residence for purposes of the above two deductions. So you can actually have two homes as your principal residence and deduct mortgage interest and property taxes on both. And this is true whether you rent them or not. Okay, so this is important because we're going to bifurcate these two items as well as other expenses into their personal use, or for these two, itemized deduction portion, and business use. So let's start with a category 1, which I describe as a primary personal use. So this is a situation where the taxpayer needs to live in the home for at least 15 days, so that's at least more than 2 weeks, and rent it out for 14 days or less, so 2 weeks or fewer. If this is the situation, then any rental income is excluded from gross income. However, no rental expenses are includable or deductible except for home mortgage interest and real estate taxes, which were deductible anyway. So let's look at an example. Mr. Hand owns and lives in a condo in Atlanta, and it's within walking distance of Mercedes-Benz football stadium, which, by the way, is where they just played the Super Bowl. So in January of 19, Mr. Hand takes a vacation to Hawaii, and as a result, he rents out his condo during Super Bowl week for $4,000. So this is not uncommon in cities where they host events like the Super Bowl or the World Cup or the Olympics. It's very common for local homeowners to do short-term rentals for their homes because they figure, wow, I can go to Hawaii for a whole week for $4,000 and make some money. And in the meantime, someone just rents my house during the Super Bowl, which I'll just watch on TV. So as a result, Mr. Hand lives in his home for at least 15 days, right? He lives there all the rest of the year. His rental is less than 15 days, right? So it's 14 days or fewer. In this case, it's only a week. So as a result, the $4,000 of income is tax-free. However, to the extent Mr. Hand ends up paying fees for something like cleaning that are associated with the rental, those expenses are non-deductible. However, of course, Mr. Hand can continue to deduct his mortgage interest and taxes as an itemized deduction as he would have otherwise. So category 2 is the in-between category, or a residence with significant rental use. So again, in this case, the home is rented now for 15 days or more. So we've eclipsed category 1, right? We're above 2 weeks. However, the personal use is the greater of 15 days or more than 10% of the total fair market value rented days. So if you've rented the home for 15 days or more and your personal use is more than the greater of 15 days or more than 10% of the total fair market value rented days, then you are in the in-between category. So what's so significant about the in-between category? Well, number one is you include all the revenue in your gross income. You are also required to allocate your expenses between personal use and rental use. If the property is used for even 1 day of personal use, those expenses must be allocated. Now, of course, it needs to be used for more than 1 day because you're trying to slot into the in-between category anyway, right? Which requires more than 15 or more than 10% of the fair market value rented days, whichever is greater. So when we do this allocation, we're going to categorize the expenses associated with his dwelling into Tier 1, Tier 2, and Tier 3 expenses. Tier 1 expenses are what we call direct expenses, or think of them as expenses to get tenants. So like I had to place an ad in the newspaper. That's got nothing to do with me using the dwelling personally. That's a direct expense, and that's a Tier 1 expense. Interest and property taxes are also Tier 1 expenses. The notion being these are deductible no matter what. Tier 2 is all other expenses except depreciation, and in Tier 3 is depreciation. So the issue with an in-between category is that once we've allocated expenses to rental use, they are only deductible in total to the extent of the gross rental income. So what this means is we cannot generate a loss for an in-between classified dwelling. The general rule is you would allocate your expenses based on the number of days used for each activity divided by the total of days used. So, for example, if you rented it for 30 days, but you used it for 180 days, then you would allocate 30 divided by 180 of your expenses to the rental activity, and the rest would be personal. There is an exception for Tier 1, which says you can allocate Tier 1 costs based on the total number of days in the year instead of the total number of days used. So recall, total number of days used would not include days where you didn't rent it. It was just open and available. Whereas the tax court method allows you to use the total number of days in the year. And we'll see an example of how that allocation takes place in a second. These expenses must be deducted in tier order. So first you deduct Tier 1, then to the extent you have additional income, you deduct Tier 2, and then to the extent you still have additional income, you would deduct Tier 3, noting that you can never deduct more than the income you generate from that property. So let's do an example. Mr. Hand and his family purchased a vacation home in Hawaii for $400,000. They paid $100,000 down, financed the remaining with a 6% mortgage secured by the home, so they have some mortgage interest on it. During the year, they used the home for personal purposes for 30 days and rented the home for 200 days. So they have $37,500 of rental income and incurred $500 of rental advertising expenses. And the other expenses are listed below. So the $500 of rental advertising expense, that's a direct expense, right? So we know we don't need to allocate that. Whereas the interest, property taxes, utilities, repairs, insurance, maintenance, and depreciation, these are all required to be allocated. So first, we really should make sure we're in the in-between category. So did we use the home for 15 days or more? Did we rent the home for 15 days or more? The answer is almost certainly yes. Did we use it for more personally for more than the greater of 14 days or 10% of the days rented? So the greater of those two is 10% of the 200 days rented, or 20 days. We used it personally for 30 days. Whoops, we're in the in-between category. Let's do the allocation. All right, so noting we have $37,500 of gross rental income, we start working down. First, let's use the IRS method, or the traditional method, if you will. So notice that we don't have to do any allocation of advertising costs. The full $500 that we incur, we allocate completely into the business portion. However, once we get into interest, property taxes, and all our other expenses, we need to allocate them based on the ratio of the number of rented days, 200, to the number of total days used, 230. So if we take 18,000 times 200 divided by 230, we get 15,652. If we take 5,000 times 200 divided by 230, we get 4348, and we work our way down through all of Tier 1. So our total Tier 1 expenses are $20,500. Our total Tier 2 expenses after allocation are another $11,304. Okay, so the problem is we can only have total expenses of $37,500. So even though depreciation multiplied by 200 divided by 230 is more than $56.96, we are limited to the amount of depreciation we can take. Because once we've deducted Tier 1 and Tier 2, we only have $56.96 of income left to deduct against. What happens to the remaining amount of depreciation allocated to the business? It gets carried forward and hopefully deducted next year. Okay, now let's look at the tax court method in the third column. Again, advertising, completely allocated. But now, when we allocate the other Tier 1 expenses, and only the Tier 1 expenses, interest and property taxes, we do that on the basis of the 200 rental days divided by all 365 days we own the property during the year. So you can see that the interest and property tax allocation is much smaller. We're actually allocating a smaller amount of interest and property taxes. Now, this shouldn't concern us too much because recall, we can take those as itemized deductions. So it's not as if we're losing the deduction, it's just being shifted over to our Schedule A as an itemized deduction. So then when we get to tier 2, notice they're the same as they were under the IRS method. It's now the rental days over the total use days. But notice what happens because we've lowered the amount of interest and property taxes allocated to the rental activity. We can now increase the amount of depreciation we take because we have plenty of income left over. So in this case, we actually end up allocating all of the depreciation that we can, all $12,121, and we still have a little bit of income left over because we didn't use it all. So what this does is it means, hey, we deducted all of our expenses now as opposed to having them limited. So that's why the tax court method can be popular. Okay, our third category is primarily rental use, or as I call it, just a non-residence. So rental days are more than 14, and personal use is now 14 days or less than 10% of rental days. So another way of thinking about it is, if it's not category 1 and it's not category 2, it has to be category 3. These are mutually exclusive categories. So when you're in a category 3, you of course include all the income. We're used to that now. But you're also eligible to deduct all your rental expenses. Again, if the property is used even for a day for personal use, you must allocate those. And in this case, you could in fact use it for just one day. The personal use portion of Tier 1, real property taxes are deductible as an itemized deduction. However, if you're a category 3 and you've only used this home for personal use for 14 days or less than 10% of the rental days, you do not get to treat it as a principal residence. And as a result, you may not deduct your personal interest, your mortgage interest on that home as an itemized deduction. You can, of course, always deduct the rental portion. Okay, so let's assume that instead the Hand family didn't use this Hawaii home for personal purposes at all. It's just too far away, but they kept it and owned it as a rental property. They received a $37,500 in gross rental income and incurred the exact same expenses that totaled $50,439 associated with the property. And the question is, how much can they deduct before considering the passive activity loss limitation? And the answer is all of it. So, because this is a category 3, they can deduct all $50,439 and therefore create a loss. However, there are some rules that we're going to cover in a little bit under Chapter 8, I believe, about passive loss limitations. And that rule says that you may not deduct any passive losses unless you also generate passive income. So think of it like the capital gain netting rules. No deduction of passive activity losses except against passive activity income. So what that means is unless the Hand family also generated passive income, that loss is actually not deductible. However, there's an exception. That exception permits you to deduct that loss if your AGI is $100,000 or less. So let's assume then that the AGI of the Hands is $140,000. Well, it's more than $100,000. However, there's a phase out associated with this exception. So the exception permits you to take up to a $25,000 loss deduction if your AGI is below $100,000. However, in this case, the AGI is above $100,000. By how much? Well, it's $40,000 over the threshold. This phase out is a 50 cent for every dollar over the threshold. So you take the $40,000, multiply it by 50 cents or 50%, and you get a $20,000 phase out. We reduce the annual limitation of $25,000 down to $20,000, leaving $5,000 left to deduct. Since the Hands loss was $12,939, they can only deduct $5,000 of that. The remaining $7,939 is suspended and carried forward. And don't worry, we will definitely come back to passive losses again because these are a little bit tricky. All right, the next item we cover is the home office deduction. And we do this in this chapter, I think, largely because it works very similar to the rental property rules. So to qualify for a home office deduction at all, the taxpayer must use his home or part of his home exclusively and regularly as either the principal place of business for the taxpayer's trade or business, right? So that's where the office is, or a place to meet with patients and clients in the normal course of business. So I think the best way to think of the home office rules is you're not allowed a deduction for any part of your dwelling. But there are exceptions. The exception is if you meet one of these two requirements. But these are strict requirements and you must meet them or else you get no deduction. So if you're self-employed, this is a deduction for AGI on Schedule C. And if you flip back earlier in the video, we actually showed a Schedule C. And if you look at the second to last item, it says home office deduction. It's right above line 31, which I think makes it line 30. So, and it is limited like a in-between rental property to the business income generated beforehand. So again, a home office deduction cannot create a loss. Now, it used to be if you were an employee, you could deduct your home office as a miscellaneous itemized deduction. So again, this is an itemized deduction, a from AGI deduction. We do these in Chapter 7. But guess what? Those were repealed by the Tax Cuts and Jobs Act, and as a result, they no longer exist. So basically, if you're an employee, you get no home office deduction. You really need to have some form of self-employment income. Okay, so let's say you do qualify. There are two methods, the actual expense method and the simplified method. So the actual method requires you to allocate expenses between personal and business use. Wow, that sounds a lot like the rental, and it is. There are direct versus indirect. Yeah, just like there were with rentals. Indirect expenses are allocated generally based on square footage. Now, sometimes you can do number of rooms, kind of depending on the type of property you're using. The deduction is limited to the gross income derived from the business. So again, if you look at Schedule C, it has you calculate the net profit before the home office, knowing that the home office is going to be limited to whatever that amount is. You organize your expenses in the same tiers 1 through 3 as we did for vacation homes. So the simplified method allows you to take a deduction of $5 per square foot times the number of square feet in your home office, limited to 300. So as a result, the maximum deduction you could take here is $1,500. This amount is also limited to your Schedule C net income less business expenses limit, just like it was prior. There's no depreciation expense as part of the simplified method. You can actually choose whichever one you want to use from year to year. So in year 1, you could use the actual. In year 2, simplified. Then you could go back to actual, then simplified, and you can just switch back and forth. All right, let's do an example. Allocate Costas has a qualifying home office. So we're just assuming that her home office qualifies. It occupies 275 square feet, and that room is used exclusively for her business. Her entire home is 2,200 square feet. Now, Allocate's business wasn't too profitable. It only earned $1,400 of gross income before considering the home office deduction. So now we need to calculate what is Allocate's home office deduction using the typical method and the safe harbor method. So in the chart below, you can see that what we've done is we've taken the electricity amount of $1,200, that's for the total house, and we've just multiplied that by the ratio of 275 square feet of the home office divided by 2,200 square feet for the entire home. Therefore, the allocated amount is $150. We can do that for the electricity, the mortgage interest, the property taxes. But notice when we get forward to repairs to the office that we've allocated the entire amount. Well, obviously, any repair specifically to that office is a direct expense. It would not be required to be allocated. Contrast that to the item below, repairs to the master bath. Well, the master bath is not part of the home office in any way. And as a result, none of those expenses should be allocated over to the home office. Cleaning gets allocated, however, depreciation would be allocated, but we suffer the exact same result we did with a vacation home. First, when we add up all the Tier 1 and Tier 2 expenses, we get to $1,300. Well, we only generated $1,400, which leaves her only a $100 deduction for depreciation. The remaining $350 that's allocated to the home office would be carried forward in an attempt to use in a future year. The simplified method, frankly, couldn't be simpler. Take 275, multiply it by 5, it's 1375. Done. Since that's less than 1,400, she can deduct all of it. All right, that brings us to the end of Module 6, and I'm sorry we had a changeover in sound quality because there's usually a bigger echo when I record in my house. Not because my house is any bigger than my office, my home office, but since I'm an employee, I can't deduct any of it. Bummer. In any event, this was a little bit longer. There's a lot of detailed stuff in here. You can also rest assured, you're going to know by the time you watch this, that we do not have any class next week. So I will be posting an online quiz for you guys to take. And make sure you pay attention to the homework problems because otherwise we're going to have to loop back around 2 weeks from now and I'll do some in class for you. All right, guys, thanks for watching.